Welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
We're both property people running our own businesses, and this podcast is just us chatting every week about the reality of anything and everything property. And I hope those of you that listened last week enjoyed the show. I know that Simon and myself really did, in terms of talking about mortgage rates and what that means to us as property investors and landlords. If you haven't listened to it, suggest that you do, because we're going to just reflect on what's happening at the moment, appreciating the fact that the world could well have changed once again by the time we've recorded this and released this. And just a quick ask from me, if you haven't already, please do leave us a rating and or review on your podcast player of choice. That would be gratefully received. And as always, if you do want to get in touch with us or for us to talk about anything, please do reach out to us on @BizOfProperty via Twitter. I know we have Alfie Chats who reaches out to us regularly, and we're going to talk about fixed and tracker today, which is something that Alfie wanted us to talk about. And of course, as always, you can reach out to us via thebusinessofproperty.com. But Simon, so we met with Simon Glastonbury, our resident broker of choice, and we were just talking about the rates at the moment and reflecting on how high they are getting, relatively speaking. What were your immediate thoughts and takeaway from that conversation?
Well, I'll expand on this a little bit, but I think, ouch, is probably my main reflection. I'm very, very pleased that I managed to get some fixed rates in a few months ago. They are clearly not in a good place right now. I'm slightly concerned that in less than a year now, I have got 2 more fixed rates expiring, and I will have to do something with those mortgages. And of course, we have no idea what's going to happen over the next year. Maybe rates will get higher. Maybe they will go higher and come back down. That is what I'm sort of hoping for. Maybe they will just stay level. I don't know. I don't think they're going to go down massively. I mean, we talked about this last week with Simon as well. None of us thought rates are going to go back down to how they have been a year ago. In fact, never mind the last decade or so. But yeah, hopefully in a year's time, it won't be quite as scary. But yeah, it's very worrying. And in terms of looking at investments at the moment, the real impact is the stress testing, because it just has such a big impact on how much money you have to put into a deal in order to be able to buy it at all, never mind to be able to make it work. And I think you had a bit of a look at a studio flat that you have against these new stress tests. And you mentioned it very briefly last week, but I think we've got some more specific numbers that you've worked out. So how does that flat stack up?
Yeah, well, I think we might have been talking about it post-record, so it might not have been something we talked about on the podcast specifically.
Oh dear, I'm getting confused with that conversation.
But yeah, it's first of all, I say, I'm one of these. I'm furiously writing down notes to say, must remember to go and check on all of my product expiry dates of mortgages, because I do have those logged. And of course, you're going to say to me, Stuart, just go to PATMA, and it's going to tell you that you do that.
Make sure you've got all your properties and all of your mortgage fixed rates recorded in PATMA, and it will send you an email 3 months before they expire, and then remind you after that as well.
Yeah, no, I'm writing a note to do that very thing. But we talked about, and Simon Glastonbury talked about the new stress test, which is 8.49%, which is 8.5% of those of us that don't worry about the 0.01s. But I immediately, the hairs on my arm stood up, and I thought 8.5% stress test on properties that were previously stressed at around 5.5, I believe. So I immediately thought of my little studio flat, because we are currently renting that for around £1,000. Now, I believe that's under market value at the moment, because like you and many other landlords, when we've had good tenants in, we tend to let them sit in the property. And if they've been good tenants, we don't really want to put that price up. So I think it's undervalued. But I had a quick look, and in summary, at a current value of around £260,000, based on this stress test that we're talking about, which is 8.5% at 145% on the rental amount, I would get 37% loan to value on that property, the equivalent of £97,000. Now, I think our borrowing is currently double that on the property. And if we were to get 75, if we wanted to really get 75% loan to value, did you want to guess on the rent I'd have to charge my unsuspecting tenants?
Oh, I think this is probably going to be slightly above even the market rate, isn't it? So go on, put me out of my misery.
Just over £2,000 for a studio flat is what that stress test would mean. And of course, that's not feasible. But the point we're making is that's how the stress test is going to affect us.
That's just a big rent increase. How long has your tenant been in there? When was this rent set?
This rent was set about 6 months ago, actually. So I think they're about to hit the 6-month number.
Okay, so you say it's a bit below market value, or market rent, should I say. It's not massively below because you put it out to the market fairly recently. Well,
but we put it out below market value because we wanted to get it filled quickly. So
okay.
The truth is, I haven't reviewed it, but I think the market rate is probably somewhere between 11 to 1,200, which in percentage terms, that's between 10 and 20%. So still a bit of an increase.
Indeed. So if we would go with the upper bound of that, 1,200, you could get a 45% loan to value mortgage.
Oh, happy days.
So there you go, 117,000 or so.
I won't get the party poppers out just yet then.
Great. So, I mean, we both have portfolios of properties that are mortgaged. And if we're looking at mortgages that are only 40-ish% loan to value, I'm pretty sure that that's a long way off what you currently have in your portfolio. And my portfolio is less heavily geared than yours. And that's some way off the loan to value I currently have in my portfolio. So I think really what that means is that although Simon said some of the remortgage products are accepting lower stress tests, I still think that that's going to be hard to switch lender. So it probably means that we're largely stuck on our current lenders for a while until these stress tests come down a bit.
Yeah, and it's as we reflected on last week, I mean, the game is what it is. So we're going to have choices, and those choices are now limited. The choices will be remain on your product that you've got and suck it up, or get out of the game. They're the two big ones, obviously. And of course, a lot of the mass media likes to talk about the second one because that drives a lot more eyeballs to your website or your newspaper, just to say that the world's going to cave in and everyone's going to sell up and what are we going to do? But of course, the middle ground for many of us is just work out, just maybe take it a little bit easier and just work out what we can do. The interesting element that you and I were reviewing as well about this was it's in some more research done by GetGround, and we'll talk about that company, and hopefully we'll get someone from the company onto the podcast soon to talk about this as well. But the GetGround, they did a survey, and their survey and research showed that, and again, some of this is not going to surprise any of us that are in property land, but it said that 93% of people, stroke investors, are struggling to find high-performing properties, and that 75% of those researched also said that they couldn't find investments that would actually work. And my understanding is that research was probably done prior to the big rates. I mean, we don't know specifically when it was done, but we'll try and get that covered off soon. But so if that was 3/4 of investors' research saying that they couldn't find investments that work, then you can only imagine that number's gone significantly up, because we'd all argue the same. However, the other option that we didn't touch on was those that can do this without leverage. So the cash buyer. And so that is the alternative, because we sit here and we're operating in the game of mortgage lending. But do we have to play that game, Simon?
Well, yes, I think.
Well, yes, and for me, yes too.
Looking again at GetGround's research, I think they said 95% of investors, for 95% of investors, the cost of buying UK property has increased in the last 12 months. So that leaves 5% of investors who think it's actually about the same. And
who are you? Contact us.
Yeah, I think basically that has got to be the cash investors, hasn't it? There's 5% of people who are cash investors.
Yeah.
I mean, if we're looking at the feasibility of new deals, if we take your studio flat as an example again, if we were to buy this new, obviously we'd have some stamp duty and things to pay on it as well. So a £260,000 purchase price, and assuming we were going to rent it for the 1,200, the upper bound what we think it could get, you'd have to put in nearly £155,000 in order to buy that, to cover deposit, which is 140 odd thousand, some fees and stamp duty and stuff. And that would give you an ROI of about 3.4%. So because you have got to put in more cash, it means that your mortgage payments are lower. So the ROI is actually still not horrendous, but you are forced to put in that extra cash. I mean, do you think 4.4% is a reasonable ROI on a buy-to-let?
I do. Obviously, we'd need to understand ROI. So your ROI is net of interest rate. We don't want to go down this rabbit hole again. We've been down this
every time we bring up ROI, we need to define it. So I'm defining it as all the rent minus all of the ongoing running expenses, mortgage payments, voids, maintenance, etc. That's the income.
But anyway, I think everyone would say if you're getting close to 4%, around 4% return, however you define that is good. I know that people with large funds right now, we're talking 6-7 figure sums available, are getting, and I'm talking about high street stuff here, but they're getting around 2%. So some slightly lower, some slightly higher. So if you're getting double that rate of interest, that's got to be appealing. And then, of course, when we think about the capital growth, and this sort of property in Greater London does attract capital growth. Of course, it's a bumpy ride right now, but would over the next 10 years. So yeah, I'd say 4% is appealing. I mean, on my maths, I just did a quick yield calculation when I was looking at this, and I think it came out, and this is probably where we don't want to go too deep, but if anyone is concerned about the terminology we're using or our correctness of it, do reach out at Biz of Property. But I looked at the yield, and it was coming out about 5%, for that property, which I think, I still think that's pretty good. Even if you're a total cash buyer, even if you went in at 100% cash buy, which I know some people have, and that they're in that fortunate position, they've worked hard to get there, could get that 5%. Why not? Because they can take their time, they can be patient, and maybe go for a much lower loan to value product at some point in the future if they want to release some of that capital.
Yeah, I mean, in actual fact, if you went in with no mortgage, at the moment, because mortgage rates are quite high and things, if you went in with no mortgage, you'd actually get an ROI of 4.5%. So yeah, you can actually get better return on investment, excluding capital growth, if you do it without a mortgage.
Yeah, and that was my back of fag packet was saying that. But of course, we know that there's only going to be a limited number of people that have got £250,000 in the back of the sofa waiting to be used. But the point we're making is that there are other avenues, and while certainly me, may well be shocked with the prospect of a 37% loan to value, just ain't going to happen in my world. But 50 to 60%, I'd love to get there. Actually, I'd really like to get there, because what that would mean is I'd have better options, hopefully a little bit more liquidity if needed. So yes, we can all be a little bit Chicken Little, particularly if we read too many of the front pages of the mainstream media. But as I think we talked about with Simon Glastonbury last week, it's really about resetting, the parameters that we work with if we want to stay in the game. That's if we want to stay in it, and I personally do, because I enjoy playing this game. And the other thing we talked about last week was really just reflecting on the fixed rates versus the trackers, and we talked about how they measured up to 20 years ago, 10 years ago. But Simon, you did a bit of research, which I thought was pretty good actually, and required a bit of effort. You looked at the last 20 years, the product you have been on in terms of variable rates versus what you would have paid with fixed rates and their fees, and just measured up the two in the last 20 years, which for me personally is a really interesting little piece of analysis. Can you tell us a little bit more about what you did?
Yes, what I did. So I put together a spreadsheet and I put into it the mortgage that I've had over the last 20 years. I mean, I've simplified it very slightly, but largely speaking, this is a real mortgage on a real house that I have actually had over the last 20 years. And this is the house that I bought as my own home initially, so it actually had a residential mortgage on it. So perhaps the rate was perhaps slightly lower than it should have been, but it was a 1.25% above base tracker. So I don't think it's that unrealistic for something that could have been a buy-to-let and things instead. But yeah, so I put together a spreadsheet and I went back through the Bank of England website to look up all of their past base rates. And they've got a brilliant page, just lists them all out. And I went through and put them into a spreadsheet. It's surprising how many years there are multiple changes of base rate, though. So I had to sort of average those out. So I've tried to cover that. And then, by way of comparison, I had to construct how this might have looked if I had been using fixed mortgages. And for that, I had to find some historic fixed rate mortgage rates. Too many rates there, but never mind.
And if you're wondering, no, Simon doesn't have a day job. This is just what he does for fun.
I am actually supposed to have a day job, but yes, on some days I do less of it than I should. So yeah, these rates, I thought, I'll just ask Google and see what I can find. And although I was rather frustrated by this, I am going to mention them by name. One of the first hits I looked at was a Statista website, I think. And I went there, and what did they do but show me a page with a really promising looking title and then a big paywall. And I couldn't see the graph, I couldn't see the numbers behind it or anything like that. So I thought, that's really annoying. Back to Google, keep searching. And I took another couple of hours or so to hunt around. I found some old Bank of England, I found current Bank of England statistics reports that show mortgage rates for the last few years, but they don't go back far enough. But then there are older releases from the Bank of England of the same statistics report, which then has further years back. So I started digging through those, and this was getting a little tedious. And I had a break and had a quick chat to my wife about this, and she's obviously thought she could do better than me, which is fair enough, normally the case. So she went and had a look for these statistics as well, and obviously did a similar Google search, found the Statista website, clicked through, no paywall. She could see all the numbers. So she had indeed managed to prove that she could do it better than me. Thankfully, this meant that I could then look at her screen and find out all the interest rates that I wanted for the last 20 years for fixed rates. So anyway, I'm sorry for making you listen to that long rambling rant about
you needed to get it off your chest. As we know, this is therapy for us.
I'm afraid in this particular case it is. But anyway, the summary is I went back and I put together a sequence of taking 5-year fixes. So every 5 years I refix. So over the 20 years I've got 1, 2, 3, 4, 5 remortgages because I've got the one just at the end as well. It's quite interesting. The rates, I'll just list each of the rates for the different mortgages. So the first one would have been, I think, about 5.8%. So relatively high. But then when I would have remortgaged 5 years after that, it would have gone up a bit to 6.1%. And then the next remortgage would have been after the crash of 2007, 2008. And the rates had come right down. At this point, the Bank of England base rate was 0.5%. But the fixed rate was apparently still about 4% for a 5-year fix. So relatively high. It wasn't until another 5 years where the Bank of England base rate had been really low for a long time now. It was only at that point that the fixed rate would have been about 1.99%, so about 2%. So those fixed rates gradually came down over that time, but they were quite high for the first 10 years, perhaps even by recent standards, relatively high for the first 15 years. So the big reveal is that on the tracker rate, over the last 20 years, I have paid quite a scary number, £120,000 of mortgage interest. That is really quite scary to think about, but it's spread over 20 years. It's not too bad, really. But if I had been taking 5-year fixes and refixing every 5 years, and this does include a little bit for fees, because obviously they're involved normally when you take out a remortgage, over that 20 years, bouncing from fixed to fixed would have cost me £176,000. So by being on a tracker and staying on a tracker, which was sort of accidental really, I've managed to save myself some £56,000, 32% of what it could have been over the last 20 years. So, Stuart, are you going to convert all of your mortgages to trackers now?
Well, the first question is, could you lend me 55,000?
No. Unfortunately, it's fictitious money.
Well, I mean, that is just really interesting to me that, if you'd have gone the fixed route, which is my preferred method, and obviously my investing is slightly different because we're HMO investing, we'll talk about that. But the fact that you've hypothetically saved 56,000 by going the route you have is so interesting because I'm going to speak for myself, but I've just never done this, and it's something I do want to do. And I think it's even more pertinent for us as investors, given the conversation we had last week with the tracker rates coming in. And of course, these will differ by product and everything else. But the tracker rate that Simon Glastonbury mentioned last week being 3.54 versus what you can currently get on the fixed now is really, really interesting to me, and means that we should be doing a bit more analysis about this over the sort of next, even in the short term, 2 to 5 years. And I think for anyone interested, please do have a look at this spreadsheet that I'm sure Simon will share via a link in the show notes.
Yep.
Because I think it's quite eye-opening, particularly for me, when you look at the period on the base rate that is at 0.5 from 2010 down to 0. Well, it gets even lower. Just so low versus what you're looking at on the fixed rates is just really interesting. And I think when it's in front of you, you realise just how stark the difference is. So the short answer to your question is it's something which I will definitely look a lot closer at in terms of that financial forecasting. I guess my personal challenge has always been quite short term, particularly when we're dealing with projects. So there's, as many of us know, when you're one man bands like we are, you've got so many problems on your plate. It's for me, getting the funding was the yippee moment. Getting the project completed, getting the en-suites built, getting the planning approvals and everything else. However, if it's going to save tens of thousands of pounds, of course, this should be one of the key property business decisions that we make, and actually is probably the primary one. But of course, we could all be limited by what we go for, because my products aren't we don't get offered as many, and even fewer now for what we do.
And of course, while this is a real world example from the last 20 years, history is no guarantee of future performance.
Yes.
And it might all be completely different. And with that in mind, I have put together a little forecast for the next 10 years. So if we're still podcasting in 10 years' time, we can come back to this spreadsheet and see if I've got it right or not. But this scenario looks at the base rate that it currently is, and then sort of feeds on from there. And I'm assuming that the base rate will go up to a height of 5% in a couple of years' time, and then drop back down and stay at a stable-ish 3%. This obviously won't happen, but that's what I'm basing it on. And then the fixed rate side of it, obviously I know the fixed rate at the moment because it's fixed for 5 years, so I've got that covered. And then when it remortgages in 5 years' time, I've gone for 5%. So again, the assumption is that the rate would have come down a bit from the current height. Who knows? In 5 years' time, fixed rate mortgages could be 10%. But we're just going to make something up for the sake of radio. And in that situation, the fixed actually comes out slightly cheaper by about 6,000, maybe 7,000 actually, across the 10 years. So 83,000 of interest for the tracker and about 75,000 of interest for the fixed. So maybe the next 10 years could have a different story.
Yeah, and the point there is that we cannot predict any of these things, but they have a significant impact on our property businesses, and we should therefore be aware of them. And certainly in my case, at least be aware when your products are expiring. If only you could see Simon's face right now, I'm sure you can guess. It's a bit probably how I look at my 5-year-old son when he's just said one of the silliest things that I've heard.
Oh, dear,
when he's asked me, when my 5-year-old son's asked me why we can't put bananas in the toaster, that's the look Simon just gave me.
Oh my goodness! Oh dear, I want to hear some more quotes from your 5-year-old. That's brilliant.
Well, I've certainly found that really interesting, and I really do hope that you as an audience have heard it. If you've listened this far, congratulations. Alfie, thank you for raising the prospect of tracker versus fixed mortgages, and hopefully this helps you. And have a look at the spreadsheet that Simon's done. I'm sure that will just give you some insight, and because the short answer to the question which you raised on Twitter is we don't know really which is better. Every one of us will have to make an individual choice based on the information we've got at hand about the price of our property, the interest rate we're being offered, and what our plans are in the future. But hopefully that just gives you a bit of food for thought on that. As always, please do leave us a rating and review, and contact us via @bizofproperty or via thebusinessofproperty.com. And other than that, we'll see you next week.